Joining us here first on CNBC is Wells Fargo CFO Mike Santomassimo. Great to see you again, Mike. Welcome.
Hi, Sarah. Good to see you again.
So what are you seeing that gave you the confidence, especially to boost that guidance?
Yeah, as we said earlier in the year, what we really needed to start seeing throughout the year was what was going to happen to the deposits, both the level of deposits, the mix of deposits between non-interest bearing, interest bearing, and then also any pressures you would see from a competitive point of view in terms of pricing. And so, as we've had more time go by, we've got more confidence that we were able to realize more than what we originally thought. And I think, but more broadly, when you look at the results, it was really good growth in net interest income, which you highlighted, good growth in fees, controlled expenses, sort of drop into the bottom line. And you look at, our capital levels, our liquidity levels, still very strong. And so we were very pleased with the overall quarter.
What about deposit pricing? There's been a lot of talk of that. How is it remaining so low, and can you keep it that low when there is competition? And we've seen deposits moving into places like money markets that pay a higher rate.
Yeah, well, on the commercial side of the business, pricing's been quite competitive now for a while, and I think that'll continue, to be the case. We don't see trends accelerating in any meaningful way, but it's definitely been competitive. On the consumer side, we raised prices last year, at the end of last year, and have really flowed that through to customers. But that's certainly seen less pressure, competitively at this point. But what you're really seeing in the deposit base on the consumer side is people actually spending their money. So the biggest draw on deposits across at least our client base is the activity we're seeing, across the economy, which I think bodes well, for the overall economic environment, at least so far.
Hey, Mike, the street's been fascinated all year long with the drawdown in excess savings, and there are all these projections based on past savings rates. I wonder how you're thinking about that and whether or not it ever truly fully gets drawn down, whether that essentially ends up as a cushion that the consumer keeps in storage because their mindset's been changed by the past few years.
Yeah, Carl, that's a good question, and I think when you look at, in aggregate, the excess savings that we saw, a lot of people think that'll get drawn down in aggregate, by at some point later in the year or year end. I go, but what you really have to do is drill into that a little bit and look at, customers that are either lower wealth or income levels versus, customers that are higher up. And I think what matters most is sort of like each individual situation. And I think the folks that are, on the lower end of the wage scale are already feeling the pressure. And in a lot of cases, have probably already spent that excess savings. And the cumulative impact of inflation over the last couple of years, I think, is definitely having a bigger impact there. And so where you're likely seeing still a lot of excess savings is probably on folks that have higher income levels. And in some cases, that may, as you point out, may be that way for a long time, or they may recalibrate how much they're going to keep going forward. So, but I do think you have to look at it in both parts of the consumer base.
You're obviously setting aside money for bad loans. Mike, what do you expect in terms of the credit environment, and especially in commercial real estate?
Yeah, well, I think you first have to start with the economic environment, and I think for the most part, I think most people would say that it's much better than you would have expected at this point in the cycle, and employment's strong, which I think bodes well. You're seeing still very good activity out there across in most sectors of the economy. And so what that means so far is that on the consumer side, you're seeing actually quite good credit performance. Some slow, gradual deterioration off of historic lows in terms of charge-offs, but overall still very, very strong. I'd say, particularly for where we are in the cycle. On the commercial side, most companies are actually still doing quite well too. All that excess liquidity they had during COVID, I think, has set them up pretty well to deal with an economic environment. And so what you're dealing now with in the commercial real estate, particularly office, is somewhat isolated. It feels to the office portfolio or the office sector. And really, that's all the things we all see in terms of the return to office trends are different. People need less real estate, and you're certainly seeing that impact a lot of different properties, and more broadly maybe now than it was 2 or 3 or 4 quarters ago. It's definitely, you're seeing that across the board in a lot of different cities, and it really is going to come down to property, like individual situations, individual properties. We still see owners and borrowers quite constructive, even in cities that have poor fundamentals. They're still putting in equity in certain cases or reinvesting in properties, and you have other situations where that doesn't make sense. So we haven't really seen that translate into substantial loss yet, but we will see weakness over time. And that's definitely going to come. And I think when you look at our allowance that we had in the quarter, that reflects that. That reflects that we expect there to be different stresses that come, and we tried to look at individual situations and a bunch of different stress scenarios to make sure we felt good about it.
Tighter bank capital rules. One of your competitors this morning referenced Vice Chair Barr's speech earlier in the week, saying it's great news for private equity, great news for hedge funds, said they're probably dancing in the streets. Is the industry speaking with one voice on that front?
Well, I think there's, the direction of capital appears to be up, and you can see that not in the Vice Chair's speech, but also in other reports that are there. I do think that the devil will be in the details of these rules, and as many people have reported, hopefully we'll start to see those rules quite soon. But I think that as you increase capital, they will have real world consequences, right? And that has the potential to move more activity outside banks. And that does help, other people, like the ones you mentioned. But I do think we have to see the devil, we have to see the details and see how it's going to impact each of the underlying businesses.
But are you saying that it will impact your appetite to lend?
Well, I think that's unclear at this point. I think we really have to see how it's going to, impact each of the, the businesses. I think it's certainly going to increase operational risk capital. It's certainly going to, impact some, parts of the capital markets businesses, depending on how, where you are. And so I think there's a number of things there, but it's really hard to generalize like the impact it's going to have, because although there's been a lot of reporting out there on it, it's a very complicated set of rules that we really have to see the detail. I would imagine this rulemaking will be quite a number of pages that we're all going to have to really go through and be really thoughtful about. But likely, as you push capital up, that does have impact in certain businesses, and exactly what that's going to be is hard to call right now.
Mike, it's been a while, but a few quarters ago, we were definitely talking about a chase regarding operating expenses, fighting for labor, trying to compete with fintech. I just wonder how you're thinking about any reversion on that front, and whether or not, for example, spending on IT is under scrutiny here, as we know financials are a huge buyer of those services.
Yeah, well, first you have to really make sure that you're investing in your businesses over a cycle, right? So starting and stopping, your investment cycle is never a good idea, and so you really need to be much more consistent about it. And technology is a big part of like what we do and what every big financial services company does these days. And so we'll continue to be pretty steadfast in terms of our commitment there. But when you look more broadly, and it's certainly the case that some of the competitiveness you've seen broadly across the the employment market has gotten a little bit better. Attrition has slowed really across the board in most areas of the company. So that's definitely helpful. Wage pressures are a little bit better, a little bit lower than they were, in the past. Mm-hmm. But I would say it's still, you still have to make sure you're compensating people competitively, because there's still, for really good people, there's still a good market out there. But I think it's definitely a little bit of a different environment than maybe we saw, a year ago. Yeah,
it kind of jives with what we hear across industries. Mike, finally, and you get this question from investors all the time, what's left for you to do to remove the Fed $2 trillion asset cap? We're how many years away from this scandal?
Yeah, look, as you know, we've got a number of things that we've got to do across all of the commitments we have with the regulators, and to build out the risk and control framework we've got. And we're happy that we've completed a substantial amount of that, but we still have more work to do. And it's our top priority to keep executing and every day and making progress. And that'll be the case until we're done.